Hello there and welcome to my channel. We continue our discussion on consolidation, and in this particular video, as I said in my previous video, we are going to continue with the various forms of purchase consideration that a parent might give to acquire a subsidiary. So in this particular video, we are going to explore all the various forms of consideration that a parent will give to acquire subsidiary, which will ultimately make that subsidiary a subsidiary of the parent, and hence forming a group. Alright, so if this is your first time on my channel, please subscribe to the channel and consider sharing the video so that it can reach a lot of other people so they can also benefit. And please like and leave comments in the comment section so that I know exactly what I will do in my next videos. Alright, so as I said, there are various forms of consideration. Now, purchase consideration is always measured at fair value. It's always measured at fair value, and this fair value can take the form of an amount of cash or cash equivalent, or the fair value of any other consideration that may be given. And those other considerations can take the form of a share exchange, deferred consideration, or contingent consideration. In my previous video, the questions that we solved were all dealing with cash or cash equivalents. So you could see that they paid an amount of cash for the acquisition of the subsidiary, but it is not always like that. In some questions, you will see the various forms of consideration being mixed up. So they'll pay cash immediately, and then some of the amount will be received at a future date, and that can be a deferred consideration or contingent consideration. Alright, so without wasting much time, let's get into it. This video is going to be very short, but I'm going to make sure that I explain everything to you so that when you see a question and then you read it, you just know that okay, this is a share exchange situation, this is a deferred consideration situation, or a contingent consideration situation. Alright, so what is share exchange? This is the form of purchase consideration where the parent is willing to offer additional shares to the already existing shareholders. I'll come again. This is where the parent offers additional shares to the already existing shareholders of the subsidiary. So at the end of the day, they are going to earn they are going to get shares in the parent instead of cash. That is what we are talking about. So a question will help us to illustrate this and to understand this better. Alright, so we have a question here, and it says part-time company acquired 80% of Sunday's $5 million $1 equity shares. As part of the consideration, part-time Co. gave the previous owners of Sunday Co. 2 shares in part-time Co. 5 shares. Every 5 shares acquired in Sunday Co. at first value. The market value of part-time Co. share was $3.50. So that is what we have here. So this question illustrates what I am explaining as share exchange. So we see that part-time has acquired a percent. I've demonstrated that in the last video. 80% of Sunday's Co. 5 million equity shares. As part of this consideration, part-time Co. gave the previous owners of Sunday Co., that is the shareholders of Sunday Co., 2 shares in part-time. Now, for every 5 shares they acquired in Sunday Co., then at the start of the year, that is as at the time the acquisition was made, the market value of part-time, who is now the parent share, was costing $3.50 per share. All right. Now, in order to confuse you, they might even bring some questions will also bring the share price of Sandyco as well. And you must always know that you will use the price of the parent and not the subsidiary. You use the share price of date of acquisition rather than the market price of the subsidiary. Always note that. All right. So the requirement, you are required to show how the share exchange should be accounted for in part-time co's separate arrangements and explain how this will differ in the consolidated financial statements. Okay, so now what are we going to do? So I have the solution here to make the video a bit shorter but detailed. So we have part-time co acquiring 4 million shares. That is the 80% of the total 5 million shares that we have in Sandyco. All right, so that is the 80%. This 80% times the 5 million, that will give you 4 million shares. Thus, when we look at it, we have actually issued 1.6 million shares. We have actually issued the 4 million, okay, multiplied by, so let me bring my equal to sign. It is the 4 million multiplied by the 2 shares that we are issuing for the 5 shares. So we have that, and then we have 1.6. So I don't know if you understand that. So it is, when you come here, it is shares we have bought being exchanged for this amount of shares, 1.6 million. So at the end of the day, we have issued additional 1.6 million shares in addition to the 4 million shares that we have issued. All right. So what do we have here? We have a double entry. Now, whenever there is an issue of share, listen to this carefully. Whenever there is an issue of share, we know that it's going to affect our share capital, it's going to increase, and then there is probably an element of share premium, which is the amount of share you buy in excess of the market value of the share. All right, so we know that from the question, a share in Sandyco is costing $1, but the parent's share is costing $3.5. So the additional 2 shares the parent is paying for the shareholders of Sandyco is going to have a share premium element of 2.5, because the shares they are owning is just $1, but now they are going to receive 3.5 for the share. So there is a share premium element. All right, so we will credit. We know that an increase in share is credited. So what do? We will credit the 80% times the 5 million, which is the 4 million shares we have already determined here, times the 2 for every 5 share. Whenever there is a share exchange, they say you have exchanged 2 for 5, 3 for 5, 3 for 6, or whatever, you pick the first value that has been mentioned and divide it by the second figure that has been mentioned. That is how I want you to get it. Whenever there is a share exchange, in this situation, 2 for every 5 shares, so 2 divided by 5 multiplied by the number of shares acquired, and the number of shares acquired is usually the parent's percentage times the total number of shares in the subsidiary, as we can see here. So the parent's percentage, 80%, multiplied by the total number of shares in the subsidiary, which is 5 million, times the share exchange ratio, which is 2/5, times $1, because that is the value, the market value of the shares in Sandyco. So that is it, 1.6. Let me cancel this here. Then there is a share premium element. As you can see, it's the same thing we have repeated, but in this share premium element, it is the 2.50. The 2.50. So that's the share premium element. How did we get that? We subtracted the $1 shares from the 3.5 shares that we have in the parent, the 3.5 million shares. Then the corresponding debit entry goes to the cost of investment in the company, the cost of investment in Sandy company, and that is what we have here as 5.6. And we calculated that using this formula here. We calculated that using this particular thing here. So we have 80% multiplying the 5 million, multiplying the share ratio, multiplying the amount of shares we bought in the subsidiary. So what I'm basically saying is that when it comes to calculating goodwill, so assuming we have goodwill, which is working straight, don't forget, it is always working straight. So goodwill at acquisition, we are going to have cost of investment, and then with this, if there is any cash element, which we have previously seen in our previous videos, you will see that we have a cash element here, and then the amount will come here. The amount would come here. Then we will have share exchange. Then the share exchange, that is when we are going to do these calculations. So for instance, if this is what we are doing for a question, then we are going to have, I'm writing it in the formula bar here, so we are going to have 80% times the 5 million shares that we have times the share exchange ratio, which is 2 for every 5 shares, times the market share price, the market value of the parent's shares at acquisition date, not the subsidiary. So that's why you are using this 3.50 here. 3.50, that is the parent's market value at the date of acquisition. So 3.50. So we'll have that. Okay, so this amount, let me cut this and paste here. So this amount will be equal to this particular value that we have here. So we'll have our 5.6 million as the share exchange. Then if there is any cash, then we add the 2. That gives us our cost of investments in this particular subsidiary. So that's what I'm saying. So that is one form of share of consideration that we will find in questions. It is very common. So I want you to grasp the concept so that you know exactly what to do when you see it. So whenever you see the parent is exchanging 2 shares for every 5 shares, then you know that it is share exchange, and this is exactly how you treat it. These ones are what is going to appear in the parent separate financial statement, but in the consolidated financial statement, this is what we will get as part of our cost of investment. You can rewatch this video to understand it better. All right, so that is it. So I've put a note here. In the consolidated financial statement, the 5.6 million is included in the fair value of the consideration for the calculation of goodwill. All right, then as the increase in equity at the parents, they will be included in the share capital and share premium / other components of equity in the consolidated statement of financial position. So this will go to increase your share capital, this will go to increase your share premium, or this will produce a share premium element in the consolidated financial statement if there is no previous share premium. All right, so that is it. Then the second part, or the second form of consideration, of other consideration you might get in questions, which is also very common, is deferred consideration. Now, deferred consideration occurs when a part of the sale price is payable at some future date. So what you are saying is that the fair value of this deferred consideration is the future value you are going to get discounted into the present using an appropriate discount rate. So that is deferred consideration. Deferred consideration is a situation where the sale price, okay, or the price you are paying to acquire the subsidiary is going to be received at some future date, or it will be payable until after a future date, and this is usually after the completion of a contract or something. Okay, but all you have to know is that it is that part of the consideration that is going to be received in the future, and it is not based on any performance in the future. It is not based on any performance. We are coming to contingent consideration so that you understand the difference. It is not based on any. It is just that the amount is going to be received in the future. So as usual, let's read the question to understand what we mean by deferred consideration. So in the additional information, usually the first additional information of a consolidation question, you will see such information as follows. The parent acquired 60% of subsidiary on 1st January 2018, 20x8 for 100,000 cash payable immediately. That is the immediate cash payment, and that's what we just viewed in our previous videos. And a further $132,000 after 2 years. That is the deferred consideration. So this amount, 132,000, is going to be received at some future date. And the future date here is after 2 years. So this $132,000 is going to be received after 2 years. That is the deferred consideration I'm talking about. All right. So the fair value of the subsidiary's identifiable net asset at acquisition amounted to 300,000. An appropriate discount rate is 10%. And the present value of $1 payable at the end of 2 years based on this rate is $0.826. Deferred consideration has not been accounted for when preparing the parent financial statement at 31st December 20x8. The parent chooses to measure the non-controlling interest as a proportion of the fair value of the net assets. That is measurement of non-controlling interest, or NCI, as a proportion of the fair value of the asset at acquisition. You are required to calculate the goodwill arising on acquisition, and then to show how the deferred consideration will be accounted for in the parent separate financial statements. So this is what we have here, and I'm going to put the solution here. All right, so let me put my solution here. To do that, let me insert a couple of all right, so we will come here and then we will have goodwill. We are to calculate goodwill on acquisition. The goodwill format, I've already given that in my previous video, so I will not go back. Now, what is it? We have fair value. Let me just make it cost of investment, because I told you we also use cost of investment instead of fair value of consideration. So we have cost of investment. Then we will have what again? For the cost of investment, in this case, is not given directly. So we have to split it according to how we have given it in the question. Now, when you read the question, it says that the 100,000 cash payable here is payable immediately. So that is cash. Then the second one is we are calling deferred. It has been deferred because it's going to be paid at a future date. So deferred consideration. So these two combined is going to give us our cost of investment. So let's come here. How are we going to do that? We'll have a dollar sign here. Okay, now the cash is 100,000 as we have already seen. So we have 100,000. Let me format this as a accounting figure with 0 decimal places. Good. Now, what is the deferred consideration? The deferred consideration is the present value. The deferred consideration is a future cash flow. It is a future cash we are going to receive. We have not received it yet. We are going to receive it in the future. So it is a future cash flow. So what we do is that in order to incorporate it into the present value, we are going to discount it. We are going to discount it using the company's discount rate. We are going to use the discount rate to calculate what we call a discount factor. If you have done financial management or you have been learning accounting, you should be familiar with discount factors. Discount factor, the formula is what? Is 1 divided by 1 plus the discount rate, which is usually R, and then we'll put this in brackets. Quickly put this in brackets. Raised to the power n. This is the formula for calculating the discount rate. Now let's verify that. For this question, we are saying that the appropriate discount rate is 10%. So the R here is our 10%. The N is the 2 years. Okay, the 2 years in which we are going to receive our payment. So we'll have one. So let me just format this and put my figures in there. So I'll have my 10% here, which is 0.1. 10% is 0.1, and then the N here is 2 years. I will put my equal to sign in front of this so that I tell Excel it is calculating for me. It has run the value to 1. So let's increase the decimal places to see what we have there. So you see that it is 0.826 rounded to 3 decimal places, and that's the same thing we have been given here. So that's why they are saying that the present value of $1 payable at the end of 2 years based on this rate is the 1 here is the $1 payable here. Now we are looking at what? 132,000. So we are going to replace the 1 that we have here with 132,000, and that is going to give us the present value of the 132,000 receivable in 2 years. So this is the present value of the amount. Let me reduce it. So that's the amount we are having here. So just like that, I'll just copy this and come and paste here. That is the amount we are using, the present value. Okay, so what did I do? You can do it in 2 ways. Because this value has been given to you, all you have to do is to pick your 132,000, which is a deferred amount, and multiply it by this discount factor. We call it discount factor to get this amount. Let's verify that. We have equals 132,000 multiplied by 0.826, and then you see that. So it is as a result of rounding. It is a result of rounding that we have this amount. We're supposed to get the same amount, but it is rounding issues. So to make it because it has been given to us, let's rather use this particular amount rather than the one we have calculated, so that your solution will always be in tune with what will be provided in the marking scheme. So I've cut this. Let me cut this and come and paste it here. All right, so that is the deferred consideration. That is our deferred consideration. If you are writing manually, you can just write brackets to show your workings. 132 132,000 multiplied by 0.826. So that's the calculation we had there. Alright, so that is the cost of investment. So let me quickly add these two figures together, and that will give me 209.33, and that is our total cost of investment, or the fair value of consideration, the fair value of the consideration. Now the next thing is to add our NCI, fair value. So add fair value, the fair value of NCI at acquisition. I'm shorting my acquisition here. At acquisition, and that can be calculated as, I'm continuing from here, that can be calculated as a proportion of the fair value of the net asset at acquisition. So if the parent acquired 60% of the subsidiary, then the NCI becomes 40%. Then we are going to multiply that by the value of the net assets at acquisition, and we are told that the fair value of the subsidiary's net identifiable net assets at acquisition amounted to 300,000. So we are going to multiply that by the value of the net assets, which is 300,000. Then what is the amount? It's going to be equal to 0.4 multiplied by 300,000, and that is 120,000. Alright, then we can again add that to this particular amount. So all equals to add this together, and that will give me 3293 that. Then the next thing is to less the fair value of identifiable net assets, and that has been given to us as 300,000. So our goodwill at acquisition is now going to be equal to this amount minus this amount, and that will give me 29,000. Let me bold it, $29,032. So let me double underline that. So that is $29,032. Let me put this together so that it makes sense. So this is how we deal with deferred consideration. Alright, so that is it. You can rewatch it again to understand what we just did here. Then the question goes ahead to ask us to show how the deferred consideration will be accounted for in the parent's consideration. Now, let me come here and do that here. So what we are saying is that when it comes to the treatment of the deferred consideration in the parent's separate financial statements, what we will do is that we are going to make use of double entry. Now, the deferred consideration becomes a liability. It becomes a liability in the financial statements of the parents, because it is a money you are going to pay in the future. So I don't know if you understand that. It becomes a consideration, and it becomes a liability. And in this particular scenario, because the amount is deferred for more than one accounting period, per the conceptual framework, the deferred consideration becomes a non-current liability. So what we will do is that the debit entry will go to cost of investment cost of investments in the separate financial statements. So that is going to be 109 and 32 here. Then we will have a credit in deferred. So we will have deferred consideration, which is actually, so let me put here brackets, non-current liability, NCL there. So let me just move this to this place. That also becomes 109 and 32. All right, so let me do that. All right, then what we'll do is that at the end of year 1, we are going to increase this amount. We want to, the idea is that because this amount is the present value, the 109 and 32 is the present value of the future amount we are going to receive. What we will do is that we are going to make sure that this amount goes back to its original 132,000 at the end of the second year. At the end of the second year, so that we will pay it all together. So what we are doing is that we are going to unwind the discount. We are going to unwinding the discount. Unwinding the discount means that we are increasing this amount, the present amount, by the rate of discount we used, so that at the end at the end of the period, we get the original amount we are looking for. All right, so at the end of this particular year, which is the year 1, we are going to unwind the discount. We are going to unwind the discount, and we do that taking this amount of ours, the present value of the consideration, and then we are going to multiply it by the discount rate, which in this case is 10%. So I have my 10% there, and that will give me 109.2. Let me reduce that. So this is the discount amount. Now this becomes a finance cost. It becomes a finance cost. When we say finance cost, it becomes finance cost in the separate financial statements or the separate statements of profit or loss. So what we do is that we are going to debit the SPL, which is the statement of profit or loss, into bracket finance cost, one zero nine and 3, and then we are also going to credit our current liabilities, because all finance costs are what? Current liabilities. They are payable currently. So current liabilities of 10903. So this is what we will have in the separate financial statement, so that at the end of the period, the amount that the amount of deferred consideration that we are going to get in the statement of financial position is going to be this for our non-current as liabilities, and then we'll also have this amount as part of our current liabilities, so that at the end of the day is going to be the addition of these two amounts together. That is going to be the deferred consideration. In the following year, we will unwind it again, so that at the end of the day we will get our 132,000 full amount. So this is how we treat deferred consideration. This is how we treat deferred consideration. Then lastly, the last consideration that we want to see here is what we are calling let me bring this down, Alt Enter. So the last one we are having here is contingent consideration. Contingent consideration is just like deferred consideration. It is also deferred, but the difference here is that it is contingent upon the fulfillment of a particular order. So what I'm saying is that the contingent consideration is an obligation of the acquirer to transfer additional assets or equity or even cash to the acquiree, that is the subsidiary, as part of the exchange for if specified future events occur or conditions given are met. So what you are saying is that with the contingent consideration, the amount is going to be payable in the future, but the payment depends on the fulfillment of some conditions that may be attached to the future payments. So we are saying that if maybe you are making losses and then the parent decides to buy you, they will pay part of the amount in cash or as a share exchange or whatever. Then the remaining amount, they will tell you that if within this the next year or next 2 years you are able to return to profitability, then we will pay the rest of the amount. That is what we call contingent consideration. This particular contingent consideration came in last year November ICA exams. Contingent consideration, it came in the exams, so take it very seriously. So what we are talking about as contingent consideration. Now when this happens, it is only the amount, take note, it is only the amount of contingent consideration agreed at the date of acquisition as contingent consideration that will be included as cost of investment in calculating our goodwill. So as usual, let's take the example and see how this is going to play out. So Prattle Company commits to paying 10 million to Swan Company in 2 years if the results of Swan Company continue to grow by 5% over that period. So this is the condition that has been given. We promise to pay in the future at a future date after 2 years if the result of the subsidiary continues to grow by 5% over the period. On acquisition, an external valuer assessed that this is not possible, so estimated the fair value of these to be $4 million at 1st January 20x1. This is the date on acquisition. This is the date of acquisition. So this is the amount that the external valuer says is possible. However, at 31st December 20x1, the valuer assesses the fair value to have increased to 6 million. So what are we saying? Prattle, the parent, has promised to pay 10 million to Swan Company, the subsidiary, if it continues to operate and grow by 5 million over that period of 2 years. Then on the date of acquisition, the parent hired an external valuer to assess that the payment of the 10 million or the growth of 5% is no longer possible or it's not probable, and so they estimated the 10 million to be just 4 million. This 4 million at the date of acquisition. Then at the end of the period of year 1, they reassessed the fair value to have increased to $6 million. Explain, that's the requirement, explain how the contingent consideration should be accounted for in the consolidated financial statement. So we have the solution here. So on 1st January 20x1, what I'm saying is that the fair value of 4 million is what will be included in the amount of consideration in calculating our goodwill. And this same amount is going to be included in the non-current assets as a provision since it is not paid yet. So what you are saying is that on acquisition, you will debit cost of investment or purchase consideration cost of investment $4 million. Let me cut this and paste it here. Then you will also credit, sorry for the huge gap, it's because of this particular in here. So we are going to credit non-current liabilities of 4 million as well. So that is what we are having here. Okay, that's what I'm saying here. So it is only the 4 million at that amount that has been agreed at the date of acquisition, which is 1st January 20X1, is what we are going to include as cost of investment. Subsequent remeasurements are not going to be included in our cost of investment, but rather they are going to be added to the non-controlling interest, the non-current liabilities. So I've put it here. At 31st December 20X1, the amount has increased from 4 million to 6 million. The difference, which is the 2 million increase, is not added to goodwill. It's not added to cost of investment in calculating our goodwill, but rather expensed to the statement of profit or loss with a corresponding entry or increase in the provision. So what you are saying is that at 31st, so what I'm saying is that at 31st December, at 31st December 20X1, we are going to debit our SPL with 2 million. So our SPO, or which is the statement of profit or loss, the SPO, with or in the name of finance cost of 2 million. Now I know where you are getting, I hope you know where you are getting the 2 million from. The difference between the reassessments, they have reassessed the amount to have increased, so from 4 million to 6 million, so that becomes 2 million. And then we are going to credit our provision. This is going to increase our provision, which is our non-current liabilities, NCL. That is also going to increase it to 2 million, so that at the end of the period, our non-current liabilities balance is going to be equal to the 6 million, and then our profit is going to reduce by 2 million, and then our cost of investment remains the same. So that when you add the 4 million to the 2 million, you are going to get 6 million, and then the 2 million plus the non-current as a 4 million is going to give us also 6 million. So this is how we treat contingent consideration. Whenever the amount is decided, only the amount decided at the date of acquisition is going to be included as cost of investment in calculating our goodwill. The subsequent remeasurement, you find the difference between the amounts at the date of reporting or at the subsequent date and the amount decided on the date of acquisition. You find a difference. That difference is going to be included in our finance cost and also increase the non-current liabilities provision. All right, so that is it for the methods of purchase consideration that we had. In this video, we have learned how to account for the other forms of consideration that may come, that may be given for the acquisition of a subsidiary. So we have the other forms to be share exchange, deferred consideration, as well as the contingent consideration. So thank you very much for your time. I hope you have learned a lot in this video. Please subscribe to the channel if you haven't done so, and please consider liking the video or sharing it with your friends, and please do consider leaving comments in the comment section so that I will know what to tackle specifically in my next video. In the next video, we are going to look at intergroup transactions. We will also look at how to account for intergroup balances at the end of the reporting period. So thank you very much, and I will see you in the next video.